Friday, June 19th, silver sitting at $64.26, down from $69.71 yesterday, down $5.45 in a single session. Every single financial outlet is telling you the same sentence right now. The Fed signaled rate hikes, so silver fell. Clean story, easy headline, case closed. Except I went and pulled the actual document, the real summary of economic projections, page by page, and what's sitting in there directly contradicts what got fed to you on television this week. I'm going to show you the exact paper trail, the March numbers versus the June numbers side by side, and one specific decision made by the new Fed chair that nobody is properly explaining. By the end of this, you'll understand exactly what changed, what didn't, and why the Fed got hawkish is a half-truth being sold to you as the whole story. 4 times a year, the Federal Reserve publishes something called the Summary of Economic Projections. Inside it sits the dot plot. Every single voting member of the Federal Open Market Committee privately marks down where they personally think interest rates should be at year end. No names attached to the dots, just anonymous projections plotted on a grid. Here's the comparison nobody's walking you through properly. In March 2026, the median dot for year-end 2026 sat at 3.4%. That's below the current federal funds rate of 3.5 to 3.75%. Translation, in March, the committee's own median view was pointing toward one rate cut before the end of this year, with a second cut penciled in for early 2027. Now look at June. The same committee, same exercise, 3 months later. The median dot jumped to 3.8%. That's now above the current rate range. 9 separate policymakers are now marking down that they expect interest rates to stay elevated or potentially move higher through the end of 2026. So in plain English, 3 months ago, the Fed's own internal consensus math said, we're heading toward easing policy this year. This week, the same group of people flipped to, we might actually need to tighten further, or at minimum, hold rates higher for longer. That's not a small wobble in forward guidance. That's a complete directional reversal in the official paperwork in a single quarter. Now here's where the proof in this video's title comes in. When markets crashed silver this week, the story sold to you by every mainstream financial channel was the Fed turned hawkish because the economy is so strong it can handle higher rates without breaking. Strong jobs, strong growth, strong economy, therefore strong Fed policy. That was the narrative. But check what else changed in that same Summary of Economic Projections document, because the data inside tells a completely different story about why the dots moved. Here's the part of the document that actually explains why the projected rate path flipped, and it is not the strong economy story being repeated on television and in headlines. In March 2026, the committee's median forecast for year-end core PCE inflation, that's their preferred inflation measure, sat at 2.7%. That's already well above their stated 2% target, but they were willing to project a rate cut anyway in that March document, accepting some above-target inflation as the acceptable price of supporting continued economic growth. By June, the committee raised that inflation forecast again. Policymakers explicitly acknowledged what they called greater than anticipated price stickiness in the official statement language accompanying the June Summary of Economic Projections. That's a direct quote from the released document, not my interpretation. Inflation is not coming down the way they hoped it would. It's stuck above target and refusing to cooperate with their earlier forecast. So here's the actual sequence of cause and effect laid out plainly in the Fed's own documents. Inflation came in stickier and higher than the Fed itself expected just 3 months ago. That is what forced the hawkish dot shift. The hawkish shift isn't a vote of confidence in a booming economy that can comfortably handle higher rates without slowing down. It's a forced retreat because their own inflation forecast from March was wrong and they had to revise it upward. That's a completely different story than the economy is so strong the Fed can afford to hike. The real story sitting in the actual document is inflation refused to cooperate with our March forecast, so we had to walk back our own rate cut plan because we're losing the battle against price pressures. One version sounds like strength and confidence. The other sounds like the Federal Reserve losing control of the one primary variable it's supposed to be managing. And here's the detail that connects this directly to what happened to silver this week. Look at the unemployment projection in the same June Summary of Economic Projections. The 2026 year-end unemployment forecast actually came down slightly, from 4.4% in the March projections to 4.3% in June. So growth projections and labor market projections stayed basically stable or even improved marginally. The only major input variable that moved hard enough to flip the entire projected interest rate path from cuts to hikes was inflation. when inflation is the forcing variable driving policy decisions, not growth, not employment, not financial stability concerns. That is historically the most bullish macroeconomic setup for precious metals, not the most bearish. Silver and gold get genuinely hurt by rate hikes that are driven by an overheating economy that clearly doesn't need continued monetary support. They historically do fine, and sometimes spectacularly well, when rate hikes are a reluctant, reactive, late response to inflation that the central bank has already lost control of and is scrambling to catch up with. Those are not the same animal. And conflating them, treating all rate hikes as equivalent, regardless of what's actually driving them, is exactly how this week's silver sell-off got fundamentally mispriced by traders reacting to headlines instead of reading the underlying document. Now here's the detail, buried in the footnotes of the June Summary of Economic Projections that I have not seen properly explained anywhere in mainstream financial media, and it directly involves the new Fed chair. Kevin Warsh, in his very first FOMC meeting running this committee as chair, did not submit a dot projection of his own. Every other voting member of the committee filled in their individual projection for where rates should be. Warsh, the man chairing the entire meeting, the man whose press conference comments on Wednesday are what actually spooked silver futures traders into mass selling, left his own square on the official dot plot grid blank. He opted out of submitting a projection entirely. Why does that detail matter? Because Kevin Warsh has been on public record for years, going back to his earlier time at the Fed Board of Governors, as a longtime critic of something called forward guidance. That's basically the practice of the Federal Reserve publicly signaling in advance where interest rates are headed as a way to manage market expectations and influence financial conditions. Warsh's argument, which he's made in speeches and academic papers repeatedly, has consistently been that the Fed should stay maximally flexible and not box itself into public commitments about future rate paths that changing market conditions might later make embarrassing or economically costly to walk back. So think carefully about what just happened this week in light of that background. The man whose verbal comments in a Wednesday afternoon press conference moved silver prices $5 in a single day refused to put his own number on paper in the official document. He was willing to talk in a hawkish tone during a press conference where reporters are asking pointed questions and sounding appropriately tough on inflation makes good optics. But when it came time to make an actual written, formally attributable commitment about where he personally thinks interest rates are going by year-end, he opted out entirely. That is not the behavior of someone with high conviction that rates definitely need to keep rising. That's the behavior of someone deliberately keeping every option open while letting the tone and vibe of his public commentary do the work of cooling down markets and tightening financial conditions, without actually putting his name on a specific numerical forecast that could later be proven embarrassingly wrong if conditions change. This is the gap between what got priced into silver markets this week and what the Federal Reserve actually formally committed to on paper. Markets reacted to a press conference tone and a general hawkish shift in committee sentiment. The hard documentation shows the chairman himself wasn't willing to formally commit to a specific projection in writing, even while other members were. There's one more piece of this puzzle that's been completely buried under the dot plot headlines, and almost nobody is connecting it to the silver sell-off. The Federal Reserve's balance sheet, the total value of all the bonds and mortgage-backed securities it's been holding on its books since the pandemic stimulus era, peaked at around $9 trillion back in April 2022. As of the most recent weekly reporting, it's been brought down to approximately $6.65 trillion. That's a reduction of about $2.4 trillion over the last 4 years through a process called quantitative tightening, or QT for short. Here's why this matters specifically for silver, and it's a completely different transmission mechanism than the interest rate debate that's getting all the airtime. When the Federal Reserve shrinks its balance sheet through quantitative tightening, it's actively pulling liquidity, actual dollars, out of the financial system. The Fed lets bonds mature without replacing them, which removes money from circulation. Less liquidity sloshing around in financial markets generally means tighter overall financial conditions, regardless of what the headline federal funds interest rate is doing at the same time. Some monetary policy analysts treat ongoing QT as roughly equivalent to additional interest rate hikes in terms of its cumulative tightening effect on financial markets and economic activity, even though balance sheet reduction never shows up as a flashy Fed hikes rates headline that moves markets intraday. Kevin Warsh has separately, in public comments before becoming chair, called for an even smaller long-run steady-state balance sheet target than where we are now. So you've actually got two tightening mechanisms potentially running in parallel: the publicly discussed and heavily debated interest rate path that gets all the press conference questions and media coverage, and a less discussed but equally real continued balance sheet drawdown that doesn't get dramatic press conference sound bites but quietly removes liquidity from the system every single month anyway. Why does this matter for the accusation in this video's title that you're being lied to? Because when the financial media reduces this entire complex story down to a simple binary of rate hikes versus rate cuts, they're deliberately or ignorantly leaving out an entire second policy lever the Fed is actively pulling right now. You fundamentally cannot fully judge whether monetary policy is actually, quote, tightening or, quote, loosening in real terms by only watching the federal funds rate while completely ignoring trillions of dollars of liquidity moving in or out of the system through balance sheet operations at the exact same time. That's not the complete picture of what's happening, and presenting only half the story while calling it the full explanation for why silver dropped $5 is, at absolute minimum, seriously incomplete and misleading. So let's put the whole paper trail together, because this is where all these details stop being just Fed policy trivia and start becoming actually useful for understanding what happens to silver prices from here. The Fed's own median dot plot projection flipped from a planned rate cut to multiple members backing rate hikes in just 3 months. That's a real, documented, undeniable reversal in official forward guidance. But the primary foreseen variable behind that flip was stickier than expected inflation, not a booming economy, which historically has been a structurally different and often more precious metals bullish setup than a strength-driven rate hike cycle. The new Fed chairman, who's driving market sentiment and price action through his press conference tone, didn't actually commit his own numerical projection to the formal dot plot document. And there's a second monetary tightening lever, balance sheet reduction through quantitative tightening, running in parallel that gets almost zero media airtime compared to the interest rate story, but has equivalent real-world tightening effects. The next Summary of Economic Projections update gets published in September 2026. Between now and then, every single inflation print that comes out, CPI, PCE, PPI, every jobs report, every GDP revision, becomes a data point the market will use to guess whether that hawkish June dot shift holds firm or gets walked back again in September, the exact same way the March dovish projection got completely scrapped by June. Here's the actual honest takeaway that nobody on financial television is going to say out loud. Nobody, including the Federal Reserve itself based on its own 3-month track record, has a reliable handle on where monetary policy actually goes from here. The dot plot moved hard in one direction in March and moved in the opposite direction by June. There is zero reason to assume that June's hawkish dots are somehow the final, stable, reliable answer when March's dovish dots lasted exactly 1 quarter before being thrown out and replaced. Quick recap for Friday, June 19th, 2026. Silver at $64.26, down $5.45 from yesterday's $69.71, largely blamed in financial media on the Federal Reserve's hawkish dot plot shift, signaling possible rate hikes instead of the rate cuts markets were expecting. But the documented paper trail sitting in the actual Summary of Economic Projections shows the median dot flipped from projecting a cut to having 9 members back potential hikes, specifically because inflation broke higher and stickier than the Fed itself expected in its own March forecast, not because economic growth is roaring. The new chairman declined to submit his own dot projection despite his press conference comments driving the entire sell-off, and balance sheet reduction through quantitative tightening is running as a quiet second tightening lever that almost nobody is mentioning alongside the interest rate story. That's the proof. Not a conspiracy theory, not a secret plot, just the actual Federal Reserve document sitting on their website versus the simplified, incomplete headline narrative that got built from selective pieces of it. Tomorrow, I'm digging into something nobody's connected to this story yet, the actual Swiss refinery backlog numbers, because raw, unrefined silver sitting in processing queues is a completely separate supply bottleneck from anything I've covered this week, and it's about to become extremely relevant. Subscribe, hit the bell, and I'll see you in the next one. John A.G. Investor, Friday, June 19th, 2026.